Let's talk about aging the accounts receivable. So, why do we do this? Well, over time, it becomes less likely that we'll end up collecting receivables. As we get further and further away from when the money was originally due, it becomes less likely that we'll actually receive that money from our customers. And companies need to be able to plan for that. That's why they can create what's called an aging schedule. An aging schedule will give a company a better estimate of their uncollectible amounts. So we've talked about how a company could estimate their total uncollectible amount by a certain percentage of the total accounts receivable, right? We could just say 7% of accounts receivable. But that's not always the best way to estimate this number, because that applies the same percentage to every dollar, no matter when it was originally due. An aging schedule, however, will allow you to use higher percentages for the amounts that are further past their due date. So let's take a look at an example problem. On January 31st, 2022, Reed Company has accounts receivable of $190,000. That's the total balance in that account. The credit terms for the company are 210 net 30. Company uses the percentage of receivables basis for estimating uncollectible amounts. The company's aging schedule is shown below. So we'll take a look at that here in a little bit. But then, with that information in the aging schedule, we are going to need to determine the total estimated uncollectible amount on January 31st, 2022. So now let's take a look at this aging schedule. We can see that we have separated the accounts receivable into different groups, depending on if the money is past due and how much past due it is. Then there's different percentages. That's saying that we're estimating that 2% of the $120,000 of accounts receivable currently not past its due date, 2% of that will eventually become uncollectible. And as we move down this aging schedule, notice that it becomes more likely that it will be uncollectible. If someone hasn't paid in 2 months since this money was originally due, there's a good chance that they just aren't going to pay, right? So that's why we see that percentage increase as we move down the table. So we're going to use this table to figure out the total estimated uncollectible amount, but how are we going to do that? So we need to use these numbers from up above and just work on it row by row. So working first with just the current account. There's $120,000 in that balance. 2% of that will become uncollectible. So let's just multiply those together. So 120,000 times 0.02, we are estimating that $2,400 will become uncollectible. And then we just keep doing that for each row. So 1 to 30 days past due. That had a balance of 27,000. 5% of that will become uncollectible. So we're estimating that $1,350 will become uncollectible from that group. 31 to 60 days past due. We take the 18,000 and multiply it by 15%. We get 2,700. 61 to 90 days past due. We take the 16,000 and multiply it by the 30%. We get 4,800. And then our last group, 91 plus days past due, $9,000, 55% will become uncollectible. So we multiply those two together and we get $4,950. So we found the amount for each of these groups. But the company wants to know what the total estimated uncollectible amount will be. Well, whenever we have a total, that means that we need to add stuff up. Our total estimated uncollectible, Let's just add up all these numbers that we just found. That's going to tell us that we are estimating that $16,200 will become uncollectible.